Hello everyone, this is Alan with Odyssey Accounting. We're going to take a look at what we're going to do coming this filing season, this tax season, filing for year 2023. Today is January 10th, sorry, have it there January 12th just because I'm going to present this again on that date. But recent changes in the tax law, we're going to take a look at some of the laws that have been changing, some legislations, including the Tax Cuts and Jobs Acts, or TCJA, sorry. And we're going to look into the Secure Act as well. So look out for changes, right? Look out for questions to ask your tax preparer, your CPA or enrolled agent this upcoming tax season. So again, the IRS announced that the tax season officially starts January 29th in 2024. However, the IRS free file is going to open in 2 days, January 12th, which means that you can submit your taxes early with a tax preparer utilizing electronic filing tax software. If that company is set up in this system, they'll be able to accept returns since January 12th. Okay, so very briefly, the Tax Cuts and Jobs Act, right? This is one of the biggest changes in the tax law that has been introduced in decades. So it's quite important, it's significant to know what kind of changes there have been. So one of them is with the standard deduction. The standard deduction doubled. However, there was the elimination of exemptions. And in 2023, for the 2023 tax year, the deduction is $13,850 for single individuals, while, for example, if you're married filing jointly, your standard deduction will be $27,700. Now, one of the key elements of the TCJA is the pass-through deduction. Before the TCJA, the pass-through businesses, including self-employed individuals, partnerships, S corporations, paid tax just based on their net income for the most part. Now, with the pass-through deduction, they can now reduce their taxable net income by 20%. So that's quite significant, although there are caveats and there are rules to it. Now, if we take a look at some of the breakdown of this 20%, so there are certain businesses that you have to look out, certain industries. If you're in that particular industry, you just need to be more careful because there's going to be more details and more specificities to it than, let's say, that you're just simply eligible for the straight 20% deduction. There are some limitations there in income. You can take a look at the chart right here and kind of follow the flow chart and see where you land. But essentially, also take a look, if you're in one of the industries, take a look at the chart here, specified service businesses. So those are generally, they're going to have a less favorable treatment with this 20% pass-through deduction. However, they can still benefit. You just have to be aware that you have to kind of be on the lookout that, okay, I'm this type of business, so I have to let my tax preparer know that I'm this kind of business, and maybe just kind of comment there, I'm aware that the 20% pass-through deduction, it affects that, so if you can take a look at that and explain it to me, you can go that route. So, and those are, if you're in law, in medicine, if you are an athlete, if you're a consultant, if you're in accounting, if you're in actuarial sciences or performing arts or financial services or even brokerage services. And in general, if you are, just in general, in any trade or business where the principal asset in your business is your reputation, that would qualify as a specified service business. All right. Now, we also get this Secure Act. What does Secure Act mean? Setting every community up for Retirement Enhancement Act. This was passed in 2019, and then there was the Secure Act 2.0, which passed December of 2022, and it modified much of the original Secure Act. Now, the stated aim is to increase access to tax advantage accounts and preventing the older generation of Americans from outliving their assets. Okay, so that's also something to be aware of, because if you're not aware of it and you have some retirement accounts, if you're within a certain age range, or if you're gonna inherit from parents or grandparents, then you really need to pay attention to this and work with a tax professional. Okay, so there's your grandpa right there. So what are the consequences here with these laws, the Secure Act and the Secure Act 2.0? One of the changes, the age of taking RMD distributions. So what does RMD mean? It means required minimum distribution. That's basic. That all that means is you're going to have to start taking money out from your IRA. You're going to have to start making distributions to yourself at a certain point when you reach a certain age. Okay. Now the age was pushed back by the Secure Act to 72 years of age, but then with the Secure Act 2.0 it got modified to 73. However, if you turn 72 before 2023, you still need to adhere to the original thing and take RMDs. Now, so that would be the age, essentially, that when you hit that age, you need to take required minimum distributions and work with your accountant, your tax preparer, to make sure that you're taking your RMD and that you're calculating it appropriately. Now, what about if you're inheriting? What about inherited IRA accounts? Now, depending on your situation, you might be required to distribute all of the IRA retirement assets that you've inherited over a 10-year period. So that's one of the things that was brought in with Secure. However, there's another option, and this is only certain individuals, you need to qualify for it, but you can also distribute them over your life expectancy. And I would say that the life expectancy is gonna be more flexible. It's just going to be more flexible in the majority of the situations, if not most of the situations. So, but you have to be aware of the rules and take a look at your particular situation. Because essentially, so if it's the 10-year period, right, you're going to be forced to take all of the IRA that you've inherited over that 10-year period, and you might end up paying more taxes, of course, because those distributions that you're taking, they're going to be taxable. And so, as opposed to the life expectancy method, it's going to be spread out over a longer period of time. Okay. Penalties with the Secure. Now here we're talking about, again, inherited IRA accounts. So if the original account holder was of RMD age, required minimum distribution age, you as the inheritor of the account, you have to take that RMD if the original owner of the IRA didn't take their RMD, you need to take them for them in the year that they passed. And if you don't do that, there are penalties. So before December 31st, 2022, if there was a missed RMD, then there's a 50% excise tax on the missed distribution. Beginning in January 1st, 2023, the Secure Act 2.0 reduced it to 25% and then to 10% if it's corrected in a timely manner. All right, so what this is essentially saying is that there are solutions in most cases. There are ways, there are things that you can do, because of course you don't want to take a 50% hit on all of your distribution. That's a big penalty there. However, that reduction in the tax only applies for a situation where the 10-year RMDs are being taken. So if you opted or if you qualified for the life expectancy method, then the 50% excise tax still applies if you miss the RMD. So this is where working with a great tax accountant can really come in handy, because even if you are trying to use the life expectancy method and you have this 50% excise tax, the tax accountant or CPA or EA enrolled agent, they can work with the IRS to try to abate the excise tax, and it's a high success rate, believe it or not. So as long as, so don't just do things willy-nilly, right? If you know that you've missed a distribution, actually work with someone, work with a professional, or you can actually call us as well. Work with a professional, because there are some additional steps that you need to take in order to really be successful in the process, and make sure that you're doing all the right moves that's going to allow you the greater chance of this abatement of the penalties. So again, these are some of the changes that we see now. So getting ready for this tax season coming up, make sure that you keep these things in mind, including the pass-through 20% deduction, which has been around now since the TCJA, but you still want to keep it in mind, because you might have another idea from previous years, and now you really want to make sure that whoever you're working with, you're taking all the right steps to make sure that you're taking all potential deductions that you can for your business, and that you're also maximizing your retirement. So again, this is Alan with Odyssey Accounting. Thank you, and I'll see you next time.